Welcome back to the Masterclass. If you are watching this, you should have already watched part 1. You should know your skint score. You should have your guilt-free pub plan set up, and you should be declaring absolute war on your toxic credit card debt while ignoring your fake student loan. You have officially stopped the bleeding. You are no longer making unforced errors. But here is the bad news. The second you get your financial house in order, you step outside and you are immediately surrounded by a system designed to strip that money right back off you. The UK economy relies on you being financially illiterate. It relies on you falling for middle-class illusions and getting trapped in cycles of debt just to look normal. Today in part 2, we are looking at the traps. We are going to expose the poverty premium that punishes you for being broke. We are going to tear apart the absolute epidemic of car finance that is keeping this country poor. And we are going to bust the biggest boomer myth in British history, the idea that renting your home is just throwing money away. Let's get it sorted. Let's start with a brutal truth that rich people don't understand. Being broke is incredibly expensive. In economics, this is called the poverty premium. If you don't have capital, the system forces you to pay double for the exact same things the rich get at a discount. If you have cash, you buy your car insurance annually and get a massive discount. If you are skint, you have to pay monthly, and the insurance company hits you with a 25% interest rate just for the privilege. If you are broke, you are put on a prepayment energy meter, which has higher tariffs than paying by direct debit. You are literally fined for not having money. But the biggest poverty premium happens when things go wrong. Imagine it is the middle of January. You wake up, the house is freezing, and the boiler has packed in. The plumber comes round and says it's going to be 500 quid to fix. If you have 500 quid in cash, it is a massive annoyance. It ruins your week. But you pay it and life goes on. If you do not have that 500 quid, that annoyance becomes a catastrophe. You have to put it on a credit card at 29% interest. Because you can only afford the minimum payments, that £500 boiler repair ends up costing you £800 over the next 3 years. The person with money paid 500. The person without money paid 800 for the exact same repair. This is how the system drains you. And the only way to break this cycle, the only way to stop paying the poverty premium, is to build what the financial industry calls an emergency fund. I prefer to call it the buffer fund. The buffer fund is exactly what it sounds like. It is a pile of cash sitting in an account that gives you the power to say, "Kick rocks," to the universe when it tries to ruin your life. Traditional financial advice says you need 3 to 6 months of living expenses saved up. If your rent and bills are £2 a month, they want you to have 12 grand sitting in cash. For someone living paycheck to paycheck, telling them to save 12 grand is like telling them to climb Mount Everest in flip-flops. It is so demoralizing that most people don't even try. Do not aim for 12 grand on day one. Your first goal, your absolute non-negotiable mission, is to save £1,000. That is it. Just 1 grand. Because statistically, £1,000 covers almost every single minor disaster that normally forces people into credit card debt. It covers the boiler. It covers the MOT failure. It covers the unexpected dental bill. Getting to £1,000 is the hardest part of personal finance, but once you have it, you build a reinforced steel shield between you and the poverty premium. But here is where people mess up. Where do you put the buffer fund? If you leave it in your normal high street current account, 2 things will happen. 1, you will accidentally spend it on a Friday night because you see the balance when you open your app. And 2, your traditional bank is paying you exactly 0.1% interest. They are stealing the value of your money through inflation. Your buffer fund needs to be slightly out of reach, and it needs to be earning its keep. You need to move that cash into a high-yield, easy-access savings account. Look at challenger banks like Monzo, Starling or Chase. They regularly offer 4 or 5% interest, and you can still get the money instantly if the boiler blows up. Alternatively, if you want to keep the money completely out of sight, put it in premium bonds with NS&I. It is backed by the government, it is 100% safe, and instead of earning standard interest, you get entered into a tax-free monthly prize draw. It takes a few days to withdraw the cash, which gives you a cooling-off period to ask yourself, is this actually an emergency, or do I just really want a new PlayStation? Once you have your buffer fund, you are protected from emergencies. But now you have to protect yourself from your own ego. We need to talk about the biggest wealth-destroying trap in the UK today. The trap that keeps working-class people broke while making them look middle-class. We need to talk about cars, and specifically, the absolute epidemic of PCP car finance. If you walk out of your house right now and look down your street, you will see driveways filled with brand new Audis, BMWs, and Range Rovers. You might think, wow, everyone around here must be earning a fortune. They are not. They are up to their eyeballs in debt. The UK is currently sitting on over £40 billion of car finance debt. Almost nobody actually owns the cars sitting on their driveways. They are using a financial product called Personal Contract Purchase, or PCP. PCP is marketed as a way to get a car you could never actually afford for a low monthly payment. But let me translate what PCP actually is. You are signing a contract to rent a depreciating asset for 3 years. Let's say you get a shiny new Audi for 400 quid a month. You pay that 400 quid every single month for 3 years. That is 14.5 grand. At the end of the 3 years, the dealership taps you on the shoulder and says, right, you don't actually own this car. If you want to keep it, you owe us a massive balloon payment of 15 grand. You don't have 15 grand because you've been spending all your money renting the car. So what do? They offer to roll you into a brand new PCP deal for another shiny new car. And the cycle repeats. You spend your entire adult life paying £400 a month for a car you will never, ever own. You are subscribing to a car. And because cars lose half their value the second you drive them off the forecourt, you are paying interest on something that is actively rotting away on your driveway. Let's do the brutal maths. If instead of renting an Audi on PCP, you bought a reliable second-hand Toyota hatchback for cash, and you took that £400 a month and you invested it into a globally diversified index fund inside an ISA. Over 30 years, that 400 quid a month would grow into over £500,000. I am not exaggerating. You are literally trading £500,000 of future financial freedom just so you can look mildly successful in the Tesco car park today. It is the ego trap. Buy a banger, drive it into the ground, and invest the difference. Right, if I haven't annoyed you enough by attacking your car, let's go after the most sacred cow in British culture. Housing. From the day you are born, your parents, your grandparents, and the bloke down the pub will tell you one phrase. Renting is throwing money away. You need to get on the property ladder. This advice is so deeply ingrained in our society that young people will completely destroy their finances, drain their emergency funds, and take on massive amounts of bad debt just to scrape together a deposit for a miserable one-bedroom flat. Let me be very clear. Owning a home can be a great foundation for wealth, but the idea that renting is a waste of money while buying is a guaranteed ticket to riches is a boomer myth that does not apply to the modern UK economy. When you pay rent, you are buying a service. You are buying shelter, flexibility, and the absolute guarantee that if the roof caves in, it is not your financial problem. When you rent, your monthly payment is the absolute maximum you will pay for housing that month. When you own a house with a mortgage, your monthly payment is the absolute minimum you will pay. People compare £1,000 rent to an £800 mortgage and think the mortgage is cheaper. They are ignoring the hidden costs of ownership. They are ignoring the thousands of pounds in stamp duty, the solicitor fees, and the surveyor costs just to get the keys. They are ignoring the building's insurance, the life insurance you have to take out, and the fact that when the boiler breaks, the 500 quid bill is entirely on you. And if you are a first-time buyer in the UK, you are probably buying a flat, which means you are dealing with the leasehold system. You don't even own the land the flat is built on. You have to pay ground rent to a freeholder, and you have to pay service charges which can literally double overnight with zero warning. You can be hit with a Section 20 notice demanding 5 grand because the building needs a new lift. Suddenly that cheap mortgage doesn't look so cheap anymore. We also have to talk about opportunity cost. To buy a house, you have to lock away a massive chunk of cash in a deposit. Let's say you need 30 grand. That is 30 grand trapped in bricks and mortar. It is highly illiquid. You can't spend it. You can't invest it in the stock market. If you took that 30 grand, continued to rent, and invested that money in a stocks and shares ISA, earning an average of 8%, the compound interest on that cash over 10 years could easily outpace the equity you would have built paying down a mortgage. I am not saying you should never buy a house. If you are settling down, you have kids, and you plan to stay in one town for the next 15 years, buying makes sense for the stability. But if you are in your 20s or 30s, you are moving jobs, or you don't know where you want to live, renting is not throwing money away. Renting is buying a shield against maintenance costs and market crashes. Do not let society bully you into signing a 35-year debt contract before you are financially ready. So, let's recap. You stopped the bleeding from part 1, and now you've built your £1,000 buffer fund to dodge the poverty premium. You've realized that PCP car finance is a trap designed to keep you poor, and you've stopped stressing about the boomer myth of the property ladder. You have officially insulated yourself from the traps that catch 99% of the working class. But playing defense is not enough. You cannot save your way to wealth. Inflation will eventually eat your cash. Now that your foundations are solid, we need to go on the offensive. In part 3, the final part of this masterclass, I'm going to teach you how the rich actually make their money. We are going to demystify the stock market, break down exactly how to use a stocks and shares ISA to legally hide your money from the taxman, and how to use your workplace pension to claim thousands of pounds of free money. If you want to finally understand how to make your money work while you sleep, make sure you are subscribed and have the notifications turned on for part 3. Drop a comment below and tell me, what is the worst financial trap you've ever fallen into? Was it a car? A credit card? Let me know. I'm Baz. Let's get it sorted. I'll see you in the final masterclass.